Let's kickstart then with our first guest on the show. We have Richard Harris, Chief Executive at Shelter Invst Mgmt, joining in. Richard, hi, good morning, and thank you so much for being with us. So central banks have sparked a bit of an equity party, haven't they? The Swiss National Bank is first off the block. The BOE is promising that things are moving in the right direction. And Fed says you can still expect 3 cuts this year. Could this revive market sentiment? And are you expecting further upside for some of the large global equity markets?
Well, I think the market sentiment has already been excited by all of this. Of course, markets tend to predict, these kind of things happening. So we have to think that maybe the immediate positive impact has gone through. But there's absolutely no doubt that the consumer is very strong, that there's low unemployment, which is keeping the markets going, that liquidity has created a surplus of money, certainly in Western markets, and that there's a momentum that's been building that's actually extending this liquidity boom further on. So we've seen the liquidity, we're seeing velocity of money, I think, quite high at the moment too. So all of this is driving a lot of markets to all-time highs. The real pivot point was really at the end of January, though. If you look at many of the markets, and indeed many of the commodity markets, that's when they first started to move. So I think that a lot of what people may be thinking of interest rate cuts is already in the market.
So how are we feeling about emerging markets like India? Because, global markets like Japan, the US markets are all sitting at record highs. Here in India, we're not too far away from our record highs, but little bit of caution now entering the system. How do you think an average investor should approach it?
Well, yes, there is some caution in the system. My general feeling is that this fairly positive tone in the market is likely to continue maybe for 2 or 3 quarters. There's a lot of momentum there. Of course, we're always dependent on the odd events that may come around that may topple the markets from their current positive state. But at the moment, I think that that's likely to continue. That will probably mean that also the Indian market will be underpinned. And even though the Indian market has really slowed down in the last month or so, we've got to remember that the market has seen an extraordinary move, extraordinary rises over the last several years. And that can only be put into context if you look at China, which has done the opposite.
Hi, Richard. Morning and good to see you in. So a couple of quick points then. Do you expect India to continue to outperform China? I recall you telling us that, a couple of months ago as well, that you're seeing an increased amount of allocation to India in comparison to China, and that's been the case. And also, how many rate cuts are you factoring in? Because that seems to be, anyone's guess as of now. How many? And is it going to be in the second half of the year? Or do you expect it to be sooner?
Well, the second question first, probably because it's the easiest one. The dot plot is showing 3 cuts this year. I think that's fairly ambitious because with the US election coming up, we're in a situation where it's going to be very difficult for the Fed to move either up or down during the hot period of the election. So I suspect there's room maybe for 2 cuts. And I suspect they'll be largely cosmetic because, let's face it, 2 cuts is just 50 basis points, and that only takes interest rates down to around 4.75%, which is still quite high. So we're talking about cuts, but this is fairly marginal. So I would actually be looking more at 2 this year. That may well disappoint the market, which will put a bit of a headwind on price movements, say from mid-year. But I think the general feeling will still be that investors will still want to get in the markets at that stage. So the picture on interest rates cuts, I think, is actually rather more muted than the market is seeing at the moment. In terms of China v. India, I think we're seeing China in a pivot at the moment. It's starting to recover. It's recovering slowly. And I think their recovery will continue to be slow and will probably underpin growth around the world. If it was too fast, we'd see commodities and oil go up, and that could hinder growth. But I think slow growth in China is likely to underpin growth around the world, which will obviously be good for India as well.
Yeah. Richard, on our screen, we have a chart that really tells the story. The Nifty is up about 30% in the last 1 year, whereas the Hang Seng is down 14%. If you look at broader Chinese mainland market indices, then the gap could be even wider, perhaps. So, what are you doing in India? Any changes to the stance here, the portfolio, and what are the themes that you're liking? I mean, the government-owned stocks, they've had a fantastic run. Do you like this part of the market, or any specifics on India?
Not really. I'm not really a specialist on India. I think a lot of your other viewers will have better views. I can only really talk from an international investor's point of view. And from my point of view, I think things still look fairly positive. I mean, clearly, we've got political issues coming up. That may affect the market. But my general feeling is that unless there's a major change, political issues tend to be short-term, but economic fundamentals tend to be long-term. So I think investors should focus more on the economic fundamentals than political. There's one great exception to that, of course, and that's the US election, where if Trump comes in, he is likely to change things. I suspect not for the better. And I think that the markets will probably feel the same if Trump looks as if he is going to win victory in November.
All right, we leave it at that, Richard. Thank you for stopping by and speaking to us on CNBC TV 18. That's the word coming in from the global market expert. Let's take a